This time last year, cafe manager Sue Park bought shares for the first time in her life, and she's made a killing.
I heard that even if you lost everything in shares, that's not the worst thing you would be worried about. Actually, the world is collapsing basically. So
Her investments in banks, buy now pay later firms and hard-hit travel companies are up more than 50%.
one of the things I hear is you have to do a lot of research. I've decided to go with blue chips, but ones that weren't very obviously evil to me.
She couldn't have picked a better time to buy. Panic selling had reached fever pitch as markets finally realised that coronavirus was here to stay.
It's been another shocker of a day on the stock market.
Equities down and down hard.
The Dow Jones in New York suffered its biggest sell-off since 1987. Then, the ASX 200 plunged nearly 10% during its worst ever trading day, losing $160 billion.
We were facing a situation that I don't think any of us in our lifetimes had ever contemplated, literally a total shutdown of world economies.
A week later, markets bottomed. The ASX 200 has jumped nearly 50% since then to its highest level in 12 months. The Dow Jones performed even better, up 76% since the crash. And Wall Street's tech index, the Nasdaq, has surged 94% since its COVID lows.
I mean, I've got friends that are just in shock and disbelief.
Penny Wong has been in the market for 3 years, and her portfolio is still down 20%, but she remains hopeful.
It's gone too far to actually sell and cut my losses. I've seen this before in 2008. At some point they'll bounce back.
Some companies which have fallen the most from their peaks in 2020 include Flight Centre, Oil Search, Webjet, Woodside Petroleum and Qantas, as lockdowns meant people weren't driving or flying as much. Some of the biggest winners over the past year are PointsBet, buy now pay later firms Afterpay and Zipco, rare earth miner Linus, Nine Entertainment and the online retailer Kogan. Even one of Australia's most successful investors in the past decade, managing $100 billion worth of assets, has been stung by the COVID crash. In the last 12 months, Hamish Douglas's Magellan Global Fund has underperformed the market with a 4% drop in its overall value. He's invested in long-term quality stocks like airports, toll roads and utilities, which have taken a short-term hit from the economic turmoil.
Our fund has to hold 50% of its assets in defensive equities. Defensive equities have underperformed the markets by around 15 percentage points. That is the nature of our strategy. So whilst it would have been nice to have rotated all the money into sort of cyclical growth assets, we can't do that.
He's not alone. Many fund managers have also taken a hit in this volatile climate. But some investors who have outperformed the market are warning parts of it may be overvalued.
What worries me is retail investors, whether they'll be nimble enough to get out before there is a significant adjustment.
Markets have been volatile because investors are worried that economies might overheat, especially with trillions of dollars worth of stimulus flowing across the world. And that might cause inflation to spike, forcing central banks like the RBA to hike interest rates sooner than expected. And experts say if that happens, it could trigger a correction.
These things tend to come to abrupt halts, but they can go on for very long periods to that point of halt.
Until then, a taste of market success will keep Sue Park investing.